Before we looked at how Jenny could make a profit and loss and the balance sheet. Now let's do the same for the cash flow. As we remember, she sells shoes for $1,000, which she buys for about $300. And on the link, we can see the deck for the P&L and the balance sheet. Now, to quickly make cash flow, this is the best way to go about it. Plug the easiest transactions first. Those are sales, cost of sales, and expenses. Net earnings or net income is the difference. Leave depreciation, interest, and taxes for later. And think about each transaction on a cash basis. When you sell something, what happens to your cash? Well, you either get paid with cash or a check, which will be cash, or if you don't, that will go into receivables. When you buy items that will go into cost of goods sold, either you use cash or if you will pay later, that will go into accounts payable. And when you spend money on different expenses, you either pay with cash or if you will pay later, that will also go into accounts payables. Following these 3 steps will make it much easier. So let's go now through each one of the transactions. We said that Jenny sells about $10,000 per month or $120,000 per year, and she gets paid in cash. Now, one of her clients bought a pair for $1,000, but she only had $671 in cash. The difference she would pay her later. So the process we're going to do is, first, we are going to book sales, which we said were for the full year, $120,000. Secondly, we are going to book receivables, which will be $329. And then we are going to book the difference into cash. So she sold the $120,000 and she got paid mostly throughout the year in cash. And on December 31st, at the end of the year, there's a tiny bit of receivables that will be left. Now, let's think about cost. Her cost is about 30% of sales. Her sales were $120,000, and 30% of that is $36,000. Now, on December 31st, when she's looking at the whole year, what she will do is she will book the cost first at $36,000, and then she will think about the part that will still be owed to her suppliers, which we said is 1 month. So that would be 36,000 divided by 12 times 1, or $3,000. And she will put the difference of what she has paid into cash. So she would say, my cost was $36,000. And for the full year, looking on December 31st, I owe $3,000 and I paid with cash $33,000. So my cash has now been reduced by $33,000 from the previous transaction. Then she will think about her expenses. We know that they are 43% of sales, and she pays all of them in cash. She doesn't owe money to other people. So first, we will book her expenses, also called SG&A, or selling and general admin, into that line. And then we are going to reduce our cash by the same amount, $51,600. And finally, if we were to stop here, we will have done the full profitability using something that is called EBITDA, or earnings before income, depreciation, and taxes, and amortization to be precise. Now, there's only just one more transaction that we will have to make on December 31st to make the balance sheet tie. So we know that our earnings before tax are $32,400, what we saw on the previous slide. And now if we were to make an entry for the line called return earnings for the same amount, then both our assets and our liabilities will tie and we're finished. Now imagine that you want to make it a tiny bit more sophisticated and you want to take into account inventory. So let's assume that she always keeps 1 month of inventory. So what we say is her cost of sales per year is $36,000. And if it's only 1 month of inventory, that would be 36 divided by 12 or $3,000. So we will assume in this case that she pays for that inventory 1 month later. So we will increase the inventory on assets by $3,000. And we will now increase accounts payable by $3,000. It was $3,000 before, and now it will become $6,000. And now our numbers tie. Now imagine that she also bought some equipment. She got a loan and the equipment, property, plant, and equipment, it's worth $10,000. So what we will do is to increase property, plant, and equipment by $10,000 and to increase the liability, the fact that we are owing that money. We could call it debt by $10,000 by the same amount. And our numbers tie again. Now, imagine that we want to be more accurate and reflect depreciation. And let's assume that this equipment lasts for 2 years. So the depreciation is 50% per year. So the first step will be to increase depreciation by $5,000. When we do that, the way that we look at a P&L or an income statement, we reduce earnings by the same amount. So we increase the depreciation chart here or the expense, and we reduce the earnings before tax. And then the last step will be to go to property, plant, and equipment and reduce our PPE by the same amount. It was 10,000 before, and now after we reduce it by 5,000, it becomes 5,000, the net property, plant, and equipment. Let's do it now for interest. Let's assume that when Jenny borrowed the $10,000, the interest per year was 5% or $500, and that she pays the interest at the end of the year. So we increase interest by $500, and we decrease cash that she used to pay for it by $500. Now let's do taxes. If her tax rate is 20% and her earnings, including all these expenses, were $26,900, we saw on the previous slide, then her tax rate will be $5,380. So we increase taxes by that amount and we decrease cash by the same amount. Now, typically the first transaction that one should have made is the one for equity, but this one is a more difficult transaction in the sense that it's hard to make sense of it. So in my opinion, it's better to make all the other transactions first and see what's happening to the P&L or income statements and the balance sheet, and to do this one last. So imagine that when she started her business, she invested $10,000, which we will call equity. So what we will do on the balance sheet is to increase cash by $10,000 and to also increase our equity capital by $10,000. And the numbers still tie. Now, based on the Excel file that is provided with this deck, you will automatically have populated this profit and loss or income statement, which is quite easy to read. It has all the different lines. There's also a bit more detail here for sales, all the way to net earnings with all the transactions that we have made before. And using the concept that we have learned before to separate the income statement into three main pieces: sales, cost of sales, and expenses. We also will have populated the balance sheet with the main ratios that we wanted to look at. And all this information is easily accessible on the Excel file. You will also be able to get this in a slightly better format for PowerPoint. It's all automatically populated for this format, and you can just write in here the assumptions that you want to use. And then when we look into future years, we can simply adjust what will happen by putting a growth rate and then calculating some other financial ratios as well. So imagine that when she wakes up on January 1st, after she was able to do all this on a rush on the evening of December 31st, she figures that she's bored and she would rather make a cash flow estimate for the next 2 years, for years 2 and 3. What she could do, the easiest way to go about it, will be to assign a ratio of growth, for example, 5%, and first to multiply all P&L lines by that ratio, by 105. Then she will manually adjust some of those lines for a lower ratio. For example, her expenses are unlikely to increase all at 5%. So she could put a ratio of 3% for those. This is the most important part of this exercise. If you have to choose how to spend your time, try to spend most of your time thinking about the assumptions, because that will have a tremendous effect on the P&L. The rest is all mechanical. And then to do the balance sheet, you will just follow the same steps that you did in year 1 after you have made each one of the transactions. So this material, the deck is on the class blog, and here's a link, and all these presentations are here on YouTube. Enjoy.